The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. I'm your host, Dan Sipe, actually the founder of Serving Those Who Serve. And additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I'm going to begin, as I always do, by saying thank you. Thank you for taking time to join us today. And above all, thank you for your service to the government, to the country, to me, to everyone. In normal times, you don't hear that enough. These are not normal times. So you are definitely not hearing it enough, but you will always hear it here. And the other thing you're always going to hear here is the guru, Ed Zerndorfer. He's back with us once again as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. So once again, we follow Ed's FedZone article. So I'm going to urge you to grab the latest article, because here we're going to be talking about the 5-year rule for Roth TSP conversions, and that's very important to know. But this is another way for us to reach and teach. And Ed always includes some really great examples and charts and everything in those, so they're terrifically helpful. So Ed, we had big news early in the year that the TSP will permit in-plan conversions from traditional to Roth. And I got to say, folks, I get to watch this in action. Ed, you've been a machine cranking out those guidelines. So today we're going to take a deeper look at a really important point, and that's the 5-year rule. And you begin with a discussion of the tax consequences. And this is important because a lot of folks may not be considering that. So walk us through.
Yes, I think it's very important that we review to start with the 5-year rule, because it can be very complicated, sometimes very hard to understand. No one said that these conversion rules are easy. And we're going to start with the Roth IRA in terms, as opposed to the Roth TSP, going, with the Roth TSP. And we hear this all the time. I would like to convert my traditional IRA to Roth IRA. What do I have to do? What do I have to know? And this is where the financial advisors are really put in a position where they got to know what to do. And then it can be challenging. So let me go through some basics here in terms of conversions of traditional IRAs to Roth IRAs. We're going to break down traditional IRAs. What is a traditional IRA? Traditional IRA was the original IRA, started in 1974, in which one contributes a certain amount. You have a certain amount of, you're limited each year as far as how much you can put in. The IRS sets the limit. That's called your contributions are limited. And when IRAs first started in 1974, all contributions to an IRA were deductible. What do I mean by deductible? Go on IRS Form 1040. There's a line item. It's an adjustment to income. It's called IRA contribution. So, example, back in 1974, and I remember that because I was first getting started in this business, IRA contribution, maybe you remember this, Dan, the IRA contribution was $1,500. $1,500. That's how much you can contribute. So one could contribute a maximum of $1,500 to an IRA, with a bank, brokerage, whatever. And let's say their gross income up until they made the contribution to the IRA was, let's say, $50,000. When they contributed $1,500 to the traditional IRA, their adjusted gross income, which is their gross income minus any adjustments, and this is one adjustment, was reduced down to $48,500, $50,000, $1,500. So what's the big benefit? The big benefit is that money goes into this IRA, you're getting earnings, you're getting a tax deduction, and everything in that traditional IRA is growing tax deferred. I say tax deferred because it's only going to be taxed when you take it out after age 59 and a half, in most cases, and you're going to pay tax both on the accrued earnings and the contribution. Why the contribution? Because you got a tax break when you put the money in. The Lord giveth and Lord taketh away. So you got the break when you put the money in. The IRS says, no, we're going to tax you and take the money out. But you got the benefit of tax deferred growth. So then in 1986, there was a major change, major tax law, major tax legislation. The Tax Simplification Act of 1986, better known as the Accountants Full Employment Act, in which Congress decided that not everybody should be able to deduct their contribution to the IRA. Who shouldn't be able to? If an individual was covered by a qualified retirement plan or a guaranteed pension, like a defined benefit plan, like a CSRS employee, like a FERS employee, you work in private industry and you're able to contribute to a 401k plan or 403b plan, federal employees, TSP, you're covered by a retirement plan. And if you contribute to an IRA, to a traditional IRA, and your adjusted gross income is too high, then you may not be able, depending on the size of your adjusted gross income, you may not be able to deduct your contribution. Now, why is that? Because you have another retirement plan. Why should you get another tax break? So Congress decided they're going to put limits as far as who can deduct their contributions to traditional IRAs. Thus was created something called the non-deductible traditional IRA. Non-deductible meaning you get no tax break when you contribute to a non-deductible traditional IRA. You do get the benefit of tax deferred growth on your earnings, though. So in other words, when you pull the money out of a non-deductible traditional IRA, after 59 and a half, you pull the money out, you will only have to pay tax on what, Dan? The earnings. Why? Because your contribution was already taxed when you put the money in. Now, my question, and I always tell the clients, how does the IRS know then your contribution went in with after-tax dollars? How do they know there wasn't? How does the IRS know this? That when you put that money into the IRA, they use after-tax dollars. After all, with the deductible IRA, I mentioned how the IRS knows that you made a contribution with pre-tax dollars because you got that adjustment to income on your tax return. So what's the answer? The answer is that when any year that one contributes to a non-deductible traditional IRA, one has to file with their income taxes a form. There's a form for everything.
Yes,
Dan.
there is.
And this form is Form 8606. 8606. IRS Form 8606. It's entitled Non-Deductible IRAs. Okay? Now, if you didn't file that Form 8606 and you take that money out of that traditional IRA, later on, down the line, after 59 and a half, and you didn't file Form 8606, the IRS is going to take the position. It's all taxable. You have no proof that you put that money in there on an after-tax basis. It's called establishing basis. Anybody out there listening, if you, since 1986, actually since 1987 when it took effect, through 2024, you made contributions to a non-deductible IRA, you can go back and file the Form 8606 just for that year. It might be a little penalty, but it's worth it because if you don't file those forms, then the IRA, when you take the money out, you're going to pay tax again on the contributions. I'm bringing this up because, like here, and we're going to get to the conversions of traditional IRAs to Roth IRAs. Anybody can convert a traditional IRA to a Roth IRA. Anybody. There's no income limitations. You can do it at any time. You can do it with any filing status. You must pay tax, though, in full on the amount that you are converting on a traditional IRA. So, with a deductible traditional IRA, how much of that IRA? Say you have a traditional IRA, deductible, let's say it's all deductible IRA, it's worth $50,000. And I want to convert all of it to a Roth IRA. How much will be included in your income?
$50,000.
Oh, let's say you are in a 22% tax bracket, federal. That's 22% of 50,000. You owe IRS $11,000.
Ouch.
Let's say you live in a state, 8% state income tax. That's another what, $4,000. A lot of money. Okay, it's all taxable. Now, what about we have a different person? They have a non-deductible traditional IRA. That's also worth $50,000. They had contributed during the years $20,000 in non-deductible contributions. So how much of the $50,000 non-deductible IRA, of that IRA, would be taxable of the $50,000? $20,000 went into contributions. It's worth $50,000. So how much would be taxable?
$30K.
That's right. How does the IRS know that?
Because you filed your forms.
8606. The Form 8606 is what's called establishing a basis, that's accounting, a cost basis. The cost basis, the money you contribute on an extra tax basis, the IRS will not tax it again. I had to give you a little basic information
That's good.
about IRAs because we're going to be talking about the TSP in terms of conversion of traditional TSP to Roth TSP.
Gotcha. And
that's the next slide.
As usual, Ed, you have some great examples. So why don't you talk us through the first one, Carl?
Okay. I just want to say that when it comes to the traditional TSP, is the TSP account, that's the original TSP account, started in 1987. 87. So everything that's going into the traditional TSP, everything, an employee's contribution, whether you're CSRS or FERS employee, contributions are going in. Where's the money coming from? Your gross salary before any federal state tax are deducted. Okay? Any earnings that are accruing are growing tax deferred. If you're a FERS employee and you get that 1% of your annual salary, your SF50 salary contribution from your agency, that's all before tax dollars. And finally, the matching contributions. So what is the cost basis? What is the cost basis in terms of when you're thinking about converting your traditional TSP to Roth TSP? What is your cost basis in the traditional TSP?
There shouldn't be one because,
Zero.
It's all taxable.
Zero. So if you want to convert, let's say $100,000 of your traditional TSP to the Roth TSP, then you have to pay tax. You have to pay tax on the whole $100,000. At what rate? Well, it's going to be at your marginal tax bracket. Oh, somebody says, well, last year I was in the 22% tax bracket. I have enough money to pay that $22,000. Well, wait a minute now. You say you're in a 22% tax bracket. That was last year. Are you going to be in a 22% tax bracket this year? Yeah, I think so. Keep in mind, you're adding the $100,000 from your conversion. Because when you convert traditional TSP to Roth TSP, the amount that you're converting is added to your existing taxable income. It could push you into the 24% tax bracket or 32% bracket or 35% tax bracket. You got to be careful here. I'm using $100,000 as an example. So under the rules for converting traditional TSP to Roth TSP, the minimum's $500. You can do and you can do up to 30 times a year, $500. But the first advice I give to anybody who's thinking of doing it is, first of all, don't do this on your own. You got to talk to a tax advisor. Know all the tax consequences of what you're doing. It may not be appropriate. That's a different issue. We have a separate column. Who's this conversion appropriate for? Right now, we're just talking about the tax consequences. So let's do the example of Carl. Try that one. Carl's age 62. He recently retired from federal service. I got this question. I had a client in New Jersey, and he had retired from federal service last year. And I said, are you interested in converting your traditional TSP to Roth TSP? He said, too late. What do you mean too late? He said, I can't do it. I said, I retired from federal service. No. Any TSP participant, whether they are an employee or retiree, is eligible to convert their traditional TSP to Roth TSP. I didn't know that. I said, start reading the FedZone columns, please. So he recently retired from federal service. When Carl entered federal service in 1995, at age 31, he contributed to both the traditional TSP and to a traditional IRA. He contributed a total of $16,000 to his traditional IRA during the period 1995 through 1999. Since Carl's adjusted gross income was below the AGI limit for contributing to a deductible traditional IRA, that was during these years, the $16,000 that he contributed to that IRA was all pre-tax dollars. Pre-tax dollars. So it was deductible traditional IRA. Okay. Now that $16,000 grew to $20,000.
Gotcha.
So what did Carl do? He decided he wanted to make his life simpler. One of the options you have when it comes to the TSP, traditional TSP, is that you can directly roll over money from a traditional 401k plan, a traditional 403b plan, a traditional IRA. Why would somebody do that? Oh, make my life simple. I got all these retirement accounts. I want to put everything under one roof. So he took the $20,000 from his traditional IRA and told the IRA custodian, please make a direct rollover to my traditional TSP account. He did. Okay. And that so by the value of Carl's traditional IRA as of January 31st of his traditional IRA account as of January 31st was $40,000, and of which $16,000, I'm sorry, we went the other way. The $20,000 was from his TSP account. I apologize. He decided after he retired, he wanted to take a little bit of his traditional TSP and make a direct rollover to his traditional IRA. It didn't go their way. It went their way. So he transferred $20,000 of his traditional TSP account to his traditional deductible IRA. So he did that right after he retired. And his traditional IRA, as of January 31st, 2026, his deductible IRA contributions was $16,000. He took all the contributions he made to his IRA, to his traditional IRA, were deductible, $16,000. He rolled over $20,000 from his traditional TSP, and he had earnings of $4,000. Add it all up, the total value of his account was $40,000. Okay? So on February 2nd, he didn't waste time, he requests a withdrawal of $10,000 from his traditional IRA. Now, the $40,000 that I mentioned, his value of his account as of January 31st, 2026, is all pre-tax dollars. So what does that mean when he took out $10,000 on February 2nd? It's all taxable. It's all taxable in terms of money coming out of his traditional IRA. It's all federally and state taxable.
Gotcha.
I want to just change one thing here. I have another example, which will change things slightly. In the case of Molly, that was my second example. Now, Molly, she's age 60. She recently retired from federal service. During the period 2010 through 2020, Molly contributed a total of $16,000 to her non-deductible IRA.
Gotcha.
Remember, Carl did it to his deductible IRA. She also requested a direct rollover of $100,000 from an old traditional 401k plan she previously participated into her traditional IRA. So she took money from a traditional $100,000 from her traditional 401k plan, rolled it into her traditional IRA account. The value of Molly's traditional IRA account of January 31st, 2026 is $16,000, which is coming from where? From the non-deductible traditional IRA. Molly made sure that during the years 2010 to 2020, she filed the Form 8606 every year, reporting her contribution. So again, the jargon of the IRS, her cost basis in that IRA is $16,000. She rolled over $100,000 of pre-tax dollars from her traditional 401k plan. She has $14,000 of earnings. Let's add it up. 16,000 plus 100,000 plus 14,000 is $130,000. Okay. Now, of $136,000, is the $136,000 taxable? Is it all potentially taxable?
Well, there's some after-tax money in there, correct?
And that's the money she put into her non-deductible IRA. So she takes out $20,000 on February 2nd. She takes out $20,000 from that traditional IRA. Is the $20,000 taxable?
Should be.
The whole thing?
Out of the traditional?
Yeah.
Because she didn't commingle them, correct?
No, she put the $16,000 of she put everything together. Money from the non-deductible IRA together with the rollover money, plus the earning, everything's in the. So the answer is the $20,000 is not all taxable.
Some of it is her basis.
So you have to go to IRS Form 8606.
Gotcha.
And because it has the cost basis there of $16,000 to work out the details. It shows in my example how that's done and how it's done using Form 8606. Of the $20,000, not the non-taxable portion is $2,462, and the taxable portion is $17,538.
Gotcha.
Woo. Okay. So that's some background information about converting traditional IRAs in terms of when you put money in and you take money out, it can get a little complicated. Sure. And one of the beauties of the Roth IRA, one of the beauties of the Roth TSP is that when you take money out of the Roth IRA, when you take money out of the Roth TSP, assuming it is a qualified distribution, there is no tax reporting, no forms, nothing. It's a relief, among other things. One other thing, this is not related to taxes. Another beauty of the Roth IRA, another beauty of the Roth TSP is that there are no required minimum distributions. Money doesn't have to be taken out. It keeps growing. So a lot of people like to get their hands on that Roth IRA, get their hands on the Roth TSP. So how do they put more money into the Roth IRA? They have to contribute each year, but there are limitations in terms of your income. How do you get money into the Roth TSP? There are no income limitations, but there is a limit as far as how much you contribute. So Secure Act 2.0, one of the provisions that came out of it was the fact that starting this year, 2026, started actually January 2028, a federal employee, a federal retiree is allowed to take portions of their traditional TSP and convert to the Roth TSP. It's called Roth TSP in plan, and anybody can do it. As I say, anybody can do it, okay? But keep in mind that anytime you convert the traditional TSP to Roth TSP, it is fully federal and state taxable. You owe tax on the amount that you're converting, okay? The amount you're converting. And like I said a few moments ago, it's not for everybody. It is not for everybody. I have a column talk about who's a candidate, who's not a candidate. We talk about this we have a monthly TSP webinar. We have a whole discussion about who should be thinking about these Roth TSP conversions and who should not be. There's a lot to be learned here. I have a FedZone column. Please attend the webinars if you have any questions. And by all means, if you need more information, you learn more about it, see if it's appropriate for you, talk to your advisor. If you don't have an advisor, I'm going to make a push now, Dan, for the Serving Notice to Serve. I know you and your team are well prepared to answer questions about these about this and just in general about the Roth TSP, Roth IRAs.
Gotcha. Well, Ed, then your article goes into the tax consequences of those in-plan conversions. And I think that's something that it shouldn't, but it comes as a little bit of a surprise to people. So they're doing the conversion and they've got a tax impact, right?
To quick follow, they're going
to do an in-plan Roth conversion. Okay.
Yes.
They've got a tax impact this year if they do it, correct?
Yeah. And I will tell you this, it comes to a surprise to a lot of people about talking about taxes in terms of someone who had to do a client to do their taxes who did a $100,000 raw, $115,000 conversion in January when it first started. And we talked about the tax consequences in terms of what, given her marginal tax bracket, what it was in 2025, we figured out that if her income is not going to change that much in 2026, and she said it's not, then in that case, I checked the tables, she's going to stay in a 24% federal marginal tax bracket, I think in an 8.5% state. So she said to me, well, how much tax would I owe? So I took $115,000 and multiply that times 24%, comes out to be $27,600. So, whoa, that's a lot of money. I said to her, do you have liquid assets, enough cash to pay that? She said, why do you say that? I got a whole year to pay the tax due, right? When I filed my 2026 taxes in the spring 2027, I said, no, you don't. No, you have to pay quarterly. She said, what do you mean pay quarterly? Come April 15, 2026, you have to pay that $27,600. Oh, they didn't tell me about this. Well, I'm telling you that the IRS has some big penalties. When you incur a tax liability in a given quarter of the year, in this case, the first quarter, the IRS is not going to wait till the following year and you file your taxes. They want the money now. You got to pay in at least 90% of what you do, ideally 100%, or else you're going to pay what's called an under withholding penalty. She said to me, well, you already have me paying estimated taxes. Can I spread it throughout the year? I said, no. She said to me, I heard there's something called the 100% rule or 110% rule, because our adjuster cost thing was 150,000, that if I match last year's tax liability through withholding throughout the year, even though I incur a large tax liability during that year, I don't have to pay an under withholding penalty. She says, no, the 100% means that you match the liability for each quarter of the year. It's not for the whole year, it's each quarter. Everyone has to think quarterly here, not annually. The IRS divides the year up actually into 4 quarters. January 1st through March 31st, April 1st through May 31st. That's the second quarter. Third quarter, June 1st through August 31st. And the fourth quarter, September 1st through December 31st. If one incurs a huge tax liability, what's a huge tax liability? You owe more than $1,000. You've got to pay that first, that payment is due April 15th that year. Incur it in April and May, June 15th that year. Incur it June, July, August, September 15th. And during the last quarter, January 15th. They want the money sooner than later. And the states are identical. I live in Maryland. Maryland has huge penalties if you don't pay that tax liability. So that's the reason I'm saying, please talk to your accountant in terms of the tax consequences of you doing those conversions.
Gotcha.
They're all taxable.
Gotcha. And then, Ed, that's on the front end of it. But as your article's entitled, now you also have to consider the 5-year rule within that Roth TSP, because there's a 5-year rule for the contributions and a 5-year rule for the conversions, right?
That's correct. Because let me just go to that 5-year rule. In terms of contributions, in terms of taking money out of Roth TSP, when can you take money out of the Roth TSP and not be subject to a 10% early withdrawal penalty, not have to pay tax on the earnings? When it comes to your contributions, in order to take money out of the Roth TSP, what's called qualified a qualified Roth TSP, distribution, you must fulfill two rules. One, you got to be over 59 and a half. Two, it has to be at least 5 years. It has to be at least 5 years since January 1st of the year you made your very first Roth TSP contribution. Dan, the Roth TSP started in 2012. It only goes back to that first year. So let's suppose we have an individual who retired on December 31st, 2025, made their very first Roth TSP contribution on July 27th, 2016. So go back to January 1st, 2018, because you back up to January 1st. Go forward 5 years, that brings you up to January 1st, 2021. Person retired on December 31st, 2025 at the age of 60. Can they take money out of the Roth TSP and not be subject to a 10% early withdrawal penalty and not to pay tax on the earnings? Answer is yes. Why? They're over 59 and a half. Two, it's been at least 5 years since they made their very first Roth TSP contribution. Only the first one. The first one. The person made Roth TSP contributions in 2017, 2018, 2019. They don't count. We're only looking at the first year in order to fulfill that 5-year rule. So that's when it comes to contributions. What about conversions? That's a different story. When one converts portions of their traditional TSP to Roth TSP, each conversion has a separate 5-year waiting rule. You have to wait 5 years since January 1st of the year that you did a conversion. If somebody they jumped on the bandwagon on the first day you could do a Roth TSP contribution. Okay? On January 28th, 2026, that's when it opened up. So when does the 5-year meter start? As of January 1st, 2026. So as of January 1st, 2031, they can withdraw the money from the Roth TSP, no tax consequences, no penalty. Then they do subsequent conversions this year. Maybe in July, they're going to do another one. Okay? Again, goes back to January 1st, 2026. Then they do more. They do more conversions in 2027. So when does the 5-year meter start? January 1st, 2027. Each one has a separate 5-year.
Sure.
A lot of paperwork here. A lot of things. You got to have a chart to know what to do.
And Ed, then when it comes time to take money, is TSP going to give them the ability to say where it's coming from relative to, the original contributions or the first conversion or the second conversion or the third conversion?
It's a good question. Again, I suppose the TSP would probably know that. They say that they want to make a qualified distribution they would take the money from the year that they made the conversions. The money would be coming from that year if it's past the 5-year period. It's a good question. Yeah. It's not going to be all lumped together. I know that. Not like the contributions.
Yeah.
Good point.
I think there's a lot of layers to this, and I think you're going to be writing about this for a long time, my friend.
Yeah.
A long time.
I know.
But
that's when we do it.
Again, I don't know how you keep it all straight, but I'm glad you do it here. I'm glad you do it with us. This is another great column. Folks, be sure to pull it up as you're following along with us because there's great examples in there. And in the main, I think the in-plan conversions are a good thing to have them, but I'm sure Ed would agree, you need to know what you're doing and you need to keep your records so that you can always match up with whatever TSP is showing. Because again, it starts getting tricky when you get to the withdrawals, if you've had them along the way. So Ed, on behalf of all our feds, thank you for all you do, especially on the tax side.
My pleasure.
Well, folks, that's a wrap. We are Serving Those Who Serve. So be sure to subscribe to this podcast on our YouTube channel or Spotify. Here's the thing. When you subscribe, you tell that algorithm that this is a valuable podcast for folks like you. and then it'll show it to more people. So you're helping yourself and you're helping other people when you do that. Also, don't forget there's live webinars every single week. Just head to the SWS website. You'll see the webinar button, click it, and you get the whole menu that comes up. Yes, the guru will come to you as we work to reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all, and share it with your friends. I promise you they'll thank you. Don't miss Ed's columns every single week in the Fed Zone. That's fed-zone.com, because we amplify 2 of them. That means there's at least 2 more in there, and they're all dynamite. So signing off for Ed, the crew in Serving the Serve, and me, Dan Sipe. Good luck, Godspeed, and above all, remember, it is your Fed life. Please make it a great one, because I know this, you deserve it. Stay well, everybody. We are out.